Now we come to the part of the show that we have on a regular basis. And this is where we discuss three things, three ideas that I think individual investors should be focused on before you make your investment decisions. And one of the things we have very often is economic data, especially if we're looking at data. We're in a battle against inflation. The central banks are trying to bring down inflation. Economic data is key because as the economic data starts to slow, that bodes well for bringing down inflation for the central banks. We're going to look at, or what you should consider, is market valuations. They're starting to creep up again. We're looking at a market S&P 500 once again in and around 20, 21 times forward earnings or 21 times earnings. And that's kind of when you start to think, okay, are markets fully valued? Are they starting to get overvalued? And I think you need to keep an eye on that. Not to say that you still can't find good quality investments, but when the overall market starts to become fully or maybe even a little overvalued, that should be it can be a bit of a red flag for a few investors. And is it time to invest more in Canada? I've said many times to many different investors, I've been investing probably for every one Canadian investment I've been purchasing, let's say a Canadian stock, I've probably been going out and buying 9 or 10 investments or stocks outside of Canada, predominantly in the US. So is it time to look back at Canada again? Is Canada now becoming an option? So we'll talk a bit about that as well. So economic data, let's delve into the first topic that I think individual investors should be considering before you make your investment decisions. And we're going to get a bunch of economic data at the end of this week and next week. We're going to see GDP, March GDP or March growth, GDP, gross domestic product, growth numbers out of Canada for the month of March and the first quarter. And right now it's looking like it's going to be not that great. We're going to see some growth, but not a lot of growth. And I think we've already seen January and February. We kind of know what March is bringing. But the hope is that April will be a lot better. So we'll get our first reading on March data, GDP in Canada, and we're going to get some quarterly numbers for GDP in Canada as well. We're going to receive, I guess, a second reading on first quarter GDP out of the US, a little different than they do it here in Canada. They get a few readings. So they get an initial reading, and then they have a revised reading, and we'll see if the GDP numbers are revised up or down. I think we get that at the end of this week. As mentioned, we're going to get a jobs number, jobs data out of Canada and the US a week this Friday. I believe that's June the 7th. And again, a very important number for individual investors to look at. And as we know, unfortunately, when it comes to this kind of data, bad news is good news. And unfortunately, good news is bad news for the stock market because the stock market wants to hear things are slowing. Jobs growth is slowing. Retail sales are slowing. GDP is slowing, but maybe not too much, but slowing. And so that will hopefully help central banks get closer to that first rate cut. And lastly, we have PCE. That is the preferred number that the Federal Reserve looks at, personal consumption and expenditures. It is a measure, another measure of inflation, and it is the preferred measure because I believe it does not take into account as much on the dwelling or the housing side of things. It's a little less emphasis placed on housing versus the CPI, which has a lot of housing data into its calculation. So we're going to get readings on PCE out of the US. And again, definitely a big potential market mover at the end of this week. So I have, again, a number of charts here to go through on the economic data. We have US real GDP, gross domestic product. And you can see here that first quarter 2024, somewhere around 1.6%. And if you were to look at the right-hand side of this, I guess, bar chart, you would see a nice gradual decline from about third quarter of last year, a little less in the fourth quarter, now a little less in the first quarter. Well, we'll see what second quarter brings. We'll start to get second quarter numbers very shortly in the US as well. And, the 1.6% was definitely an underperformer for the U.S. We're starting to see the economy losing some momentum in Canada. Our next chart shows that some Canadian GDP starting to lose some momentum. You see here March GDP or March growth numbers were basically zero, flat. Coming out of February, where things were a lot better. They were looking for a point, came in at 0.2, looking for a 0.4 number. And so a little bit disappointment in February, but still we saw some growth versus March, where we didn't see much growth at all. So we can definitely see that the Canadian economy is slowing down along with the US economy as well. Our next chart that we have here talks a bit about that PCE number, personal consumption and expenditures number, US inflation gauges here. You have core CPI, core PCE, core PPI. Talk a bit about that sometimes, and those are wholesale prices. So we have consumer prices, CPI, wholesale prices, which is your PPI, and then the personal consumption and expenditures number. And what you notice here on this chart is they're all sloping from the top left to the bottom right, which is exactly what you want to see. So if we continue to see numbers like this, numbers going from the top left to the bottom right on PCE, on CPI, on PPI out of the US, I think you're going to see that, or you're going to hear that the Fed is starting to get a little bit closer to that first interest rate cut. Some are now predicting it. I believe Goldman Sachs predicting first cut maybe as early as September. I'm going to push back against that a little bit. I don't think that first cut is coming until at the very earliest, beginning of fourth quarter. And more than likely, we may not see it cut till right at the end of the year. I think the market is pricing in a cut, I think a high rate of a cut come December. So if that happens, then we may see some more cuts in 2025, but nothing substantial in 2024 on the US side of things. And as I mentioned earlier, if we do get cuts in Canada without getting cuts in the US, just not sure how many interest rate cuts we would see out of the Bank of Canada before the US starts to cut rates. Second point we had on our list that I wanted to get to is market valuations creeping up. And as I said, we're starting to see market valuations in and around 20 times, just over 20 times earnings. And one of my favorite charts I kind of wanted to show right off the bat is this one on market fair value. And I think it's a great chart to show, one of my favorites for the show this week. And the orange, as you can see here, represents overvalued, where the chart is above one standard deviation above the mean. And you can start to see once you get a lot above or well above that 1 point mark, 1.04, I think it got to in March or mid-March, you're starting to see overvalued territory. And what happened in April? Well, in April, we had a sell-off. And so in April, what you would see here, starting at the beginning of April, you saw the sell-off by mid-April, third week of April, end of April, and then the market became or moved into oversold territory or undervalued territory. And then recently, back in May, we've rebounded again. So a good chart to take a look at. But for investors in general, I think when you look at the markets, I think when you start to say, okay, well, things are starting to creep up. Do I want to still be buying into this market, even though valuations are a little bit stretched? You have to look at why valuations are stretched. And when you talk about the overall market, it's technology again. Names like NVIDIA are really pulling this market forward, are really causing or pushing this market higher and higher. So if you're not looking at some of the big cap tech names like NVIDIA, like Amazon, like Alphabet, or even an Apple, Apple's been on a bit of a run lately. What else is there? And you'll find that everything else is just doing all right. We are seeing that the market breadth is expanding. We are hearing that or seeing that other areas of the market. We've talked about this on other shows, pharmaceutical, bank, retail names doing well and seeing their stocks moving higher. So they're joining in on the market gains, we're joining in on the party. But I would say that for the most part, this rally is still on the back of big cap tech names. So even though we may say the overall market is creeping higher, the valuations are creeping higher, I still believe that you can buy things, many things actually, that are still relatively cheap. And those are the investments you want to take a look at. So yes, you want to own some of the big cap tech names, as I've said, for growth, but then you want to look at other areas that haven't moved up as quickly, other areas that are still doing really well, having good earnings, good top line, bottom line growth. Because in my opinion, there still are many names on the S&P 500 and even on the TSX that you could look at. So even though the market is creeping up, these are names that you could find that, if they pay a dividend, even better, but you could add to your portfolio over time. The third point I wanted to get to, again, that I think individual investors should consider or think about before you make your investments is, should I be buying more into Canada at this time? And Canadian investments have been doing well. The Toronto Stock Exchange is up about, let's call it 6.5% year to date. Not too bad. On pace to do, I guess, over 13% for the year. If we have a second half of the year as good as so far what we're seeing in the first half. Compare that to the S&P 500. The S&P 500 is up in and around, let's call it maybe 12% for the year so far. The NASDAQ also in and around up about 12, 13% in that range. So again, the TSX underperforming the New York indices, the US indices, the S&P 500, the biggest North American indice. And that's why, as I said earlier, that for every one investment in Canada, for many years now, I've been buying many investments in the US primarily, and even some in other areas outside of Canada. Going back to the TSX right now, I wanted to focus on what's driving the TSX. And let's put up a chart of the TSX that we have, and that is a one-year chart. And you can see here, not often do you see a chart of the Toronto Stock Exchange doing as well as it has. And really, it's taken off, I guess, from the end of October of last year up until present. It's done well. We saw a dip in and around April, and you'll find a very similar chart for the NASDAQ, the S&P 500. You'll see the dip in April, and you'll see things really taken off as of the end of October last year. And the reason for the TSX doing well, in my opinion, has been really because of just a couple of areas. And those areas are one, materials, mining, gold. Gold stocks have done extremely well. Price of gold has shot up to all-time highs over the past few weeks, few months. And I think that's really helped the TSX. There are a lot of gold miners on the TSX. Commodities in general have done extremely well, whether it's base metals like copper, whether it's silver, other base metals have done extremely well. Other commodities have done well. Oil is sitting in and around that $80 mark once again. So this is all good. It's good when countries such as China are back in growth mode and importing a lot of the commodities that they need for growth, the metals that they need, the copper, et cetera, and other base metals, aluminum, et cetera, that they need to build infrastructure and to grow. Whenever we're in growth mode around the world is growing again. It's good for Canada because we supply a lot of the materials that the rest of the world needs to grow. So that has really been helping the market. And we have another chart here on commodity prices over the last 6 months, and you can clearly see how commodity prices have fared. They've been doing quite well. And again, that combined with mining of gold, materials, and even banks have kicked in and done somewhat better, not still as good as I would like to see. And I think there's more growth to come. But Royal Bank reached all-time highs recently. Bank of Montreal has done well. Even CIBC has had a good run. Scotiabank, from their last quarterly report, not just the one we just had, but even from the previous one, has done well as well. So is it time to consider Canadian investments? I think there are some you can consider. But once again, I think when building a portfolio, you're probably going to find yourselves investing a lot outside of Canada. I know a lot of money managers, mutual fund managers, even though they're Canadian mutual fund managers, they're looking at being exposed as much as they can to markets outside of Canada. So they have 48, 49% of the mutual fund, the Canadian mutual fund, invested in US or outside of Canada. So if those professional money managers are doing that, it makes sense that you would think that a lot of investors are following in that on that path as well. So keep in mind some of the Canadian investment ideas before you make your investment decisions. I think there are a few good ones out there, but overall, I still believe you're still going to be investing a lot outside of Canada. And I think if you look for good quality names wherever they may be, I think that's the best recipe for success, whether it's outside or inside. And obviously, if they pay a dividend, that is fantastic while you wait for the growth to come.